Today's lesson is on income tax. First, we're going to talk about what income tax is and what part of your income is taxable. So income tax is a percentage of your income collected by the government to fund its services and programs. Collecting your federal income tax begins with gross income or total income for the year. Now, this gross income includes wages, tips, interest, dividends from investments, unemployment compensation, profits from a business, rental income, and even game show winnings. Anything that comes into your bank account increasing your value would be part of gross income. Now, the next step in calculating your federal income tax is to determine your adjusted gross income. Adjusted gross income is figured by taking the gross income, which is the total income, and subtracting certain allowable amounts called adjustments. Now, adjustments are untaxed income that includes retirement plans, tax-deferred savings plans, interest of student loans, and alimony payments. To get the adjusted gross income, you're simply going to take the gross income minus any adjustments. Now, you're also entitled to certain exemptions and deductions subtracted from your adjusted gross income before calculating your own taxes. So the exemptions can be any fixed amount on your return for each person supported by your income. This number is determined by the IRS. Everyone has a fixed amount for an exemption, and it's just subtracted. The standard deduction is a lump sum amount that you can subtract from your adjusted gross income. Again, this number is determined by the IRS. Now, if you have itemized deductions, you can list those separately if you have encouraged a large number of deductible expenses. The itemized deductions include interest on home mortgages, state income tax, property tax, charitable contributions, and medical expenses exceeding 7.5% of adjusted gross income. Now, you only may choose the standard deduction, which is determined by the IRS, or the itemized deductions if you have a lot of things that you can list separately, whichever one is larger, but you can only have one of the two. The probably trickiest thing to think about for the itemized is the expenses, medical expenses. You can only include those if they exceed 7.5 of your adjusted gross income, whereas the other ones you can go ahead and just include mortgages, mortgage interest, state income tax, property tax, all of those things you can just go ahead and include. But the medical expenses is the ones that it has to be a large amount of medical expenses exceeding 7.5% of your adjusted gross income, which we'll show you in an example a little bit later. Now, many people choose a standard deduction because they're not yet eligible for numerous deductions associated with owning a home or making charitable donations. So therefore, the itemized deductions most often for young people are smaller than the standard deduction. So in that case, the standard deduction will be better probably for a lot of students or young people. Now, the taxable income is figured by subtracting the exemptions and deductions from the gross income. So we have this formula here. Taxable income equals adjusted gross income subtract, in parentheses, exemptions plus deductions. So there's a lot of words here, a lot of definitions that you need to know. Is this an adjustment? Is this an exemption? Is this a deduction? Before you can actually evaluate the taxes. So let's do an example here. So let's say a single woman earned $87,200 and received $2,680 in interest from a savings account and contributed $3,200 to a tax-deferred savings plan. She is entitled a personal exemption of $4,050 and a standard deduction of $6,300. The interest on her home mortgage was $11,700, and she paid $4,300 in property taxes and $5,220 in state taxes. And she contributed $15,000 to charity. So we're supposed to A, determine the woman's gross income, B, determine the woman's adjusted gross income, and then C, determine the woman's taxable income. So there was a lot of information there. So let's first just look at the gross income. The gross income, that's the total amount of income that's going to come in for this woman. So we have wages, that's part of gross income, which I'm going to be doing in orange. We also have interest from a savings account, and then she contributed $3,200 to a tax-deferred savings plan. So the $3,200 in tax-deferred savings is actually an adjustment. Okay, so that belongs in the adjustment category. So for right now, the gross is just going to be $87,200 plus the interest that she earned from her savings account. And if we add those up, that's going to get me 87200 plus 2680. That's going to get me 89,880 as her total gross income. Now we're going to reread and we're going to try to find things that are adjustments. Now remember, adjustments are untaxed income. That includes retirement plans, tax deferring savings plans, student loans, or alimony. The only one that she has here is the $3,200 in the tax deferred savings. That's going to be an adjustment. Okay, so how am I going to get the adjusted gross income? Well, the adjusted gross income is just going to be my gross income, which is $89,880, and I'm going to subtract the $3,200 from the savings plan because that's tax deferred. It's part of the adjustments, and that's going to come off. So now I take, since 89,880 is already in my calculator, I can just then subtract 3,200, and that's going to get me 86,680 as the woman's adjusted gross income. Now, we had a lot of exemptions and deductions, so we have to analyze those as well to get the woman's taxable income. So to get the taxable income, we're going to get the adjusted, which is 86,680, and I'm going to subtract two things. I'm going to subtract the exemptions and the deductions. So let's see if we can't find any exemptions. Let's keep reading. She's entitled to a personal exemption of, okay, so the personal exemption here is $4,050. And then we have to talk about deductions. Now, deductions are a little bit trickier because we have two types of deductions. We have standard and we have itemized. So for the standard deduction of $6,300, now I can either pick the standard or the itemized. So if the standard's bigger, then I'm going to go with $6,300 exactly. Now if the itemized was bigger, then we'll go with that, but I got to figure that out first. So the mortgage on her home was $11,700. That's one item. She paid $4,300 in property taxes. Property taxes are another itemized deduction. We also have state taxes, which are $5,220, and she also contributed $15,000 to charity. All of these items are in the category of itemized deductions. The only thing missing here would be medical expenses, which weren't listed there, so I don't have to worry about that. So when I add all these up, I'm gonna come over here and just add them up. So we got 11,700 plus 4,300 plus 5,220 plus 15,000. Already right there, I'm sure that this is going to be a whole lot more than the standard. So 36,220 is going to be the itemized. So between the standard and the itemized, we're definitely picking the itemized because that's much larger than the standard. So I would prefer to deduct the larger. So when I go back to my calculator, I take the 36,220, which are the itemized deductions, add the personal exemption, which is the 4050, and that's going to be 40,270. Now I'm still taking my adjusted gross income and subtracting that, so I have 86680 minus the exemptions and deductions, and that's going to get $46,410 of taxable income. So even though she brought in a whole lot more because she spent a lot on her home mortgage and property taxes and charity, her taxable incomes goes down quite a bit from her gross income and even from her adjusted gross income.